Hello, welcome all of you to Las Vegas 2022. It's a pleasure to be here and actually to see all of you in person. This is the first ICA in-person event in 3 years. So we have a fantastic lineup coming ahead of keynote speakers, industry experts who will be presenting to you over the next 2 days, and we hope you enjoy it. It is my pleasure to introduce our first keynote speaker of the event, Ron Lawson. Ron Lawson is the head of Logic Advisors and is, I believe, very well known to all of you. So, welcome, Ron.
Well, first of all, I'd like to thank the ICA for inviting me. And I think we all need to raise a glass to the incoming President, Tim North, who just became a father to a baby girl. Here's to Tim. Congratulations. You know, when they first talked to me about this, and the theme was getting back together. And, you know, 40 years of doing this, you get to know a lot of folks. You get to recognize a lot of faces. But, you know, some may not recognize me, so I figured just in the, maybe this will help. Okay, maybe not. All right, enough of that. What I'd like to talk today about are the things that have changed, not necessarily just over the last 3 years, COVID, but what has changed in our world, the wonderful world of cotton. And when we look at the, get the clicker out here, the way we approach the markets and trying to figure out what's going to happen is we look at the foundation of analysis. And as you see up here, here's some axioms that we live by. All intelligence and intelligent data is information, but not all information is really intelligence. A lot of the information you're starting to see these days, social media, is false. And yet we buy into it like it was chiseled in stone. Some data is not equally useful to us all, but it still floods our computers every day. I feel that the luxury of perspective can only be paid for by the currency minted through age, experience, and wisdom. And I look to you folks out there that I've known for years, and when we first started coming to these meetings, we were the young kids, and now we're the silverbacks. Don't know how that happened. I don't feel like I'm that old, but yeah, we are. So it's that wisdom that comes to play. I've said this to a number of people the last 2 days. Look around. These aren't your competitors. Your competitors are computers in New York running algorithms and in every major business center in the world. The information flow that's coming through big data from the cloud is driving our markets like they never have before. And we'll get into what that means and what it means to you. But 85% of all the trading volume is done by computers, driven by algorithms. Human hand never touches it. And that's just something you have to keep in mind. Okay, this is the basics, and this is gonna, for some of you, this is a big rehash, but just know, we see 4 legs of fundamental analysis, 4 legs of analysis: fundamental, technical, structural, and money flow. I will say that traditionally in our cotton markets, fundamental has been the way we've looked at it. What's the supply? What's the demand? What's the use? What's the carryout? What were the beginning stocks? What's going to change? Okay? And when we get to the major source of our data for this, we turn to the WASDE report. And we had one this morning. This showed small adjustments, and it's had some interesting effects on the market. We're currently down 164 after being up marginally when the report was released about 10-15 minutes ago. The thing to remember is that this data is look back. It's meant to be giving us forward guidance, but the WASDE is all made up from models that the USDA puts together. And they include some things that you wouldn't necessarily naturally think are involved. One of the things I point out is that their consumption models include spinning machinery sold in the world. Well, you'd say in normal times, that makes sense. If there's increasing spindlage, there's going to be increasing consumption. But let's look what happened during the supply chain problem and on the heels of COVID. In countries like Turkey, they bought more machinery than the rest of Northern Europe combined. And that's factored into the USDA's model of consumption. But yet, as we sit here today, it's estimated Turkey's spindlage is only running at 20%. So here the USDA's got built into their numbers some significant increases in consumption that simply aren't there. So when we look at all that, that's something we have to take into account. Okay, so the author, Tom Clancy, was being interviewed once, and questioning his writing for both reality and for fiction. And as you can see here, the difference, and this is how he answered, the difference between fiction and reality, fiction has to make sense, okay? We're in a real world, and I put up these two charts, this chart, and I had to adjust it 3 times leading up to this because of the election, WASD, you know, we had all the algorithms were negative on cotton, and then the rumor got around that China was going to reopen, there wasn't going to be a zero COVID, and we went ballistic. But if you look, the WASD from October of 21 compared to October of 22, there's very little difference in the data, in the hard data points. And I'm going to point out carryout, the far right columns, because that's basically, if you want to boil it down to an essence, carryout's what we really care about. There's very little difference, but yet in 2021, this number came as the market was exploding to the upside, and here, very little change data. The next year, the market's collapsing. So that's reality. Does that make sense? We all have to live with this. That's what I'm trying to point out, that you've got major fundamental data flows that seem to point in one direction, yet the market does completely different things. And as I'll point out, the numbers today, the carryout, if you look to the far right, US carryout went up to 3.0 from 2.8. We went to 87.27 on the world carryout, so actually declined. And then 50.40 on the world without China. So those are the numbers. The market moved up on the flash, and now we're down 159. So that's, as fundamentals go, you know, we all kind of live and breathe by how many bales are out there in the world, and I'm not going to say that's not useful. I believe it, you know, supply and demand, ultimately the fundamentals drive the market, but they aren't what drive the futures market. And that's what we're here to discuss. You folks are involved with the physical bales. Me? I'm not cursed with the cash market. I don't have to worry about things like, I worry about the futures market. That's what I'm here to try and help show you how things are being driven these days. The second pillar of technical analysis, is technicals. Now, I'm going to, with the permission of Ernie Schroeder Jr., I'm going to cite his father, who claimed that all technical analysis was black magic, voodoo, and witchcraft. Senior was not a fan. But I will tell you it's not. And what I try to explain is on a chart, there's hundreds of ways to interpret that information. You've heard stochastics, moving average, you know, golden cross, all these different ways to interpret the numbers. But keep in mind a couple of things. All a chart really is a manifestation of what people are willing to pay or to sell cotton for. That's just a reflection, that's it. Is there a psychological importance? Yes. You know, you can look at where there's support lines, pretty easy to see where the market gets to a certain point, and resistance lines, where it comes off. And these are tools you can use the charts to find if you are looking to buy, where would you put your purchase order? If you were to sell, where would you put your selling? So they're very handy, but they're not the end-all to be-all. And I'll cite, if you've been following the Elliott wave theorist who used the Fibonacci numbers, while the market was coming apart, they kept saying, oh, no, this is just a third of a sixth of an A of a B or a C, and then they kept refreshing, and they finally threw it up and said, yeah, we're wrong. So you get any kind of technical analysis, and they're not always right. They're good tools, but they're stuff to use. One of the things I was taught, it was 40 years ago at Merrill Lynch Broker Training School. They brought in a fellow who was head of technical research, a guy named John Gambino, a bit of a legend on the energy markets. And he's looked around at all this big-eyed rookies, didn't know anything. He said, okay, look, print the chart, put it on the wall, take 10 steps back. What direction's it going? And that's been one of the most useful tools I've found in the long term. Just put the chart on the wall, step back, and take a look. That's going to give you more solid information than trying to figure out the Elliott wave, my opinion. So the charts are very useful. They tell you when to get in, when to get out. But more importantly, if you're a money manager for a hedge fund and you're in charge of trading commodities, you don't know the difference between a bushel, a barrel, or a bale. You can't be an expert. They can't hire one of you for cotton, one of you for gold, one of you for pork bellies. They have to have a generic analysis. They use technicals. They put their buy and sell points using technicals. They use the charts to guide them. You can use the charts because you know what they know. They don't know what you know. They don't have a grasp of what you know. So there's an advantage in that you can see things through their eyes that they can't through yours. Okay, structural, the third leg. This is the kind of information, I believe, that is mostly used as trends in following trends or reversals of trends. But there's also things that stick up like red herring. And I'll give you an example. Last week, when the market was coming apart, we had heard the rumblings that there was Chinese fixations. Okay, market's down, they're good traders, they're probably buying when they need it. Monday in the market, there was an 8,500 contract EFS, exchange for swap. Now, I won't go into the technical details of that, but just think about this. In one trade, one fell swoop, one entity bought 850,000 bales. Someone else sold it. Who do you know is big enough to do that? I mean, I couldn't afford that. How about you? Right? So my point is that we look at certain things like EFPs, EFS, exchange for risk, EFRs. When you see these, they're indications that something has happened. A significant something has happened depending on the size. There's other stuff structurally. We all watch the search stock. A little different today than it used to be because you can push a button, insert it. When we look at our weekly export sales, tenderable percentage of the cotton crop as it's coming in. What's the quality? We'll go over this a little later, but the cotton to soybean value ratio when it comes planting time. Open interest, volume trends. The whole time the market was rallying up and then sold off, the open interest continued to climb. Well, what we saw that as prices drop and the open interest going up, it was the hedge funds shorting the market. You folks buying it on value. They were selling it on a technical chart. It's going down, the trend is lower, stay short, add to shorts. You guys were looking at the value. This price has got too cheap, and we're buying it. All of a sudden, news comes out, rumor, China may not go zero COVID. That caused all the hedge fund algos to reverse their position, and the trade stepped back. No natural seller. So these are the kind of things that we follow on a daily basis, hourly basis, and keep our guys in touch with. So other things that are easy for you guys, length, strength, color, micron, all that stuff is only pertinent to the cotton market. And that's something that, these are all the structural things within the business that your years of experience give you the advantage over your true competitors, which are the speculators. Okay, the final leg is something that I think most people have come to realize well, certainly since COVID, it's the money flow. Phrase I coined actually at the London Cotton Exchange dinner a number of years back. Specs have more money than the trade has cotton. And you can, we can go back and name names of companies that are no longer in existence because as well-known Bobby Wheel told me once, he said, "Rocket Man," he says, "when millionaires get into the ring with billionaires, millionaires lose." And true, the best way to look at it is if they, we have a client over in London who's he trades for a big bank. And where he trades is for the Goldman Sachs index, commodity index. And he moves his loaf of bread, 6-pack of beer, gallon of milk is $100 million. One lot, $100 million. So he's in, he's out, he's back and forth. You think about it, they could buy and sell the entire world's crop and not know they owned it. And that's how much money's flowing around out there. So that's just something to keep in mind. And when you look at how much money is available today because of the ultra-low interest rates and the efforts of global money center banks to pump the economies up to try and keep us out of a COVID disaster, you look at this chart, and this is how much money hedge funds have to put in to the marketplace. It's immense. And you have a market that is predisposed for inflationary thoughts, basically driven by energy, but also by fears of recession. So which one is going to happen? Which way are we going to go? One of the things, when we look at all this data, is that the US dollar through this entire move has been positive. And it's more where do I put my money that's the safest place? The old line, it's the cleanest shirt in the dirty laundry pile. So that's what's partially driven the dollar to go up as it has. Okay, as we analyze, there's some things that that you have to accept that nobody is ever right all the time. And here's some of the main causes where we've seen guys in the past have some real problems. Okay, bias towards optimism. Old Billy Dunham had told me one time, he says, "Yeah, you're the eternal bull." And I kind of thought that was a compliment. No, he was beating on me. He's, you get optimistic, over-optimistic, unrealistically optimistic. And while that's great for a life in general, it can be expensive. So everything is not necessarily going to get better. Everything you hear is not necessarily true. That's even bigger and have a bigger impact today given the social media that's driving things in the markets. Another thing, mirror imaging. Just because that guy's doing it doesn't mean it's right for you. We see guys who are operating at different levels, trading against, they may be, I always tell the story about I had a big cotton farmer out there one time. He called me up and he says, "Rocket, this is great." He says, we just passed $1 million we made in your account. I said, "Johnny, you dumb son of a bitch, you're 50% hedged. You've lost $2 million somewhere else." "That's someone else's problem," he says. So mirror imaging can really hurt you if you're trying to match up with what someone else is doing. Keep your own position in mind. One of the things groupthink is another phrase I've coined: forget what you believe and believe what you see. So often we get caught up in our beliefs. Well, this should be, that should be. No, what is. Believe what you're seeing, and it goes back mostly to put the chart on the wall, take 10 steps back. And that's the reality that you deal with, okay? Another thing that's come up, this is more of I'd say last 4 or 5 years, disruption. Disruption of service. Disruption used to be a bad thing, but apparently in today's millennial world, disruption's good. Uber, they disrupted the taxi business. Facebook, they disrupted the mail writing letters to people. But disruption is what we're faced with. And you have to be understanding that conventionality, while wisdom is beneficial, it's helpful, know that for every one of you that feels comfortable in the conventional approach, there's 100 guys out there trying to figure out how to make you wrong. So just keep your eyes open, head on a swivel. Complacency, okay? It's imperative you test your stance against the backdrop of changing conditions. Don't ever feel comfortable. If you feel comfortable, something's going to get you. And I'm not trying to put stress into your life or build any kind of paranoia. And what's the old line? Just because you're paranoid doesn't mean they're not out to get you. But just stay alert, because things are definitely changing. We see it coming from all angles. Okay, so philosophically, I look at cotton. I've long held that cotton is the longest and best leading economic indicator there is. And when you look at the whole array of futures contracts that trade, there's only two markets that take 18 months to go from conception to consumption. That's cotton and cattle. Okay, think how long it takes to put seed in the ground to buying a pair of pants at Levi's. Along the way, these are all the things that come into play, all the economic factors that affect that process. Each one of them has a very subtle but real effect on the value of cotton. And these are things that we all look at, we read, but it's the old thing, you put the frog in the water and then you warm it up, it doesn't realize he's boiling. But these are all the things that cotton has. So it's been a very reliable barometer for forward-facing global economic conditions. You can go back on the charts, as we often do, and we find that big declines in cotton have preceded some very significant global catastrophes. 9/11 was one of them. We saw cotton prices come down, no real reason, boom. It was a couple of times, the Asian contagion, we saw that same thing. So keeping cotton as a leader in your global economic outlook, you do it anyway, but it just gives you some early warning. It's the canary in the coal mine. Okay, here's some of the shifting supply side fundamentals that we got to take into account, okay? This goes into agricultural cost rising. You look at the chart in the upper middle, that's the ammonia price and urea. Fertilizer expenses have gone through the roof, okay? And as that occurs, farmers are making different planting changes. We're all going to start looking at it between now and the March 31st intentions. Some of the things you have to remember, one of the things is that agricultural products are now energy commodities. Biodiesel, ethanol, has turned corn and soybeans into energy markets. So they have an additional analytical consideration that must be taken into account. And as far as production goes, I'll look at the lower right. We have found that the price ratio between cotton and soybeans has evolved from a 12-to-1 ratio to a 14-to-1 ratio, break even. So a farmer's going to plant. I'm either going to plant beans or we're going to plant cotton. Look ahead at new crop prices. I break even right about a 14-to-1. We're at 19-to-1. Soybeans are worth 19 times cotton. So that would lead you to believe that soybeans are a better choice for those farmers that have the opportunity. Here's what's going on. Typically this time of year in the United States, across the Mid-South, the Delta, they're looking forward to what they're going to do. They pick the cotton. They'll come in and they put a cover crop of wheat just to keep the soil together until it's planting time. Seed rates are 200-300 pounds an acre. Okay. What we've got from our seed salesmen, what we've heard from the companies that sell the seed, is farmers are planting 1,200 pounds an acre. They want to harvest this wheat. They don't want to use it as a cover crop. And it's gotten to be so acute, they've run out of planting seed. So as the crop has become harvested, the cotton crop, guys are planting heavy wheat crops to harvest and literally the next day drill in a soybean crop. So if you're already getting a 19-to-1 ratio return on beans and you throw in a $10 wheat crop, you're not planting cotton. It doesn't make sense. The input costs are too expensive. And while the fertilizer prices have backed off, there's a severe shortage of diesel. And we put this news out. This is the kind of stuff we put up charts. People, what'd you put that chart in there for? Well, to show you that the amount of diesel in storage right now is below the 7-year average. It's going to be a very tight season as we go into next year. There's not going to be enough diesel, and it's going to show up in the prices. So that's the decisions as we look forward. Who's going to plant what? And at this point, it doesn't look like you're going to get a whole lot of cotton in the ground in the U.S. And that's not the only place that there's a problem. Okay, China, the ultimate wild card. Like I pointed out, just on the rumor that China was going to stop its zero COVID policy, the market exploded. There are a lot of things going on in China that aren't necessarily hitting the airwaves right now. Every day we get the notice from the USDA on the exports of grain to China, soybeans, wheat, corn. We look at what's going on in China. They're auctioning off their wheat, auctioning off their beans, auctioning off their frozen pork. There's a food problem in China, and it's not getting better. 30 years of drought has caused the Yangtze River, Yellow River, to reach low levels, and it's seen that there may not be enough water to grow the food required to feed the people of China. And of the water that is available, it's dire. So for instance, in China as a whole, they consume 700 times as much water each day than they do crude oil. Okay? Of that, a UN study shows that 19% of the Chinese surface water is unfit for human consumption. 7% for any use. Underground water, it's worse. 30% is unfit for humans, 17% for any use. Why? It's their farming practices, okay? They use 2.5 times as much fertilizer and 4 times as much pesticides as U.S. farmers on 25% of the arable land. And when you compare it to the rest of the world, they're using 30% of the world's fertilizer on 9% of the arable land. And it's going into the water. So as they have a water shortage, fertilizer prices continue to go up. Energy prices, if they reopen, are expected to really take off. They're going to have a hard time feeding themselves. So what does that mean for cotton? Well, if it was really a true capitalist society, the Xinjiang, who are growing something that's basically radioactive outside of China, nobody wants, we saw that Brazil's traceability is key. We're getting traceability for all fiber. Nobody in the world wants Xinjiang cotton, except China. Well, if you're running a for-profit organization, the country can't feed itself. You've got $10 wheat. Why wouldn't you switch out of cotton into wheat? Yes, there's some infrastructure considerations, rail, how do you get it here, how do you get it there? But there's a very real possibility that in this coming planting season, China makes a major shift to produce food, not fiber. And that's going to affect everybody. That's going to be a tremendous impact if we see that kind of move. So keep that on your radar. The pushback I always get from that is, oh, well, they'll just switch to polyester. We'll just make that change. There was a study I just saw this afternoon or this morning that they're testing the guts of whales, and they're finding how much microfiber plastic is in the gut of whales. That's 200 times what they thought. And it's not coming from the water, it's coming from the fish they eat and the plankton. Microfiber, the plastics in the water, my opinion, it's going to be the millennials' DDT. Those of us old enough to remember Silent Spring and what DDT did and the big pushback globally, I believe the plastic situation in the water is going to become that type of role. Greening, sustainability, all this is snowballing downhill. And one thing that we have that polyester can't, we have a biodegradable product that doesn't pollute, that it isn't a forever chemical. So I believe that that's going to help support cotton demand, because people are going to gradually want to have more natural fiber. It'll be more hemp, more silk, more bamboo, more other products, but still, that stuff that biodegrades is what's going to be the future, I think, for textiles. On the demand side, there's some real big picture things to consider. Most of it's population. China's got a population problem, so if they don't have enough food, well, they don't have enough people either. So it continues to see the trends. And these are all charts that will be made available, I hope, that you guys can get through the, you don't have to look at them here. But the idea is we aren't even having replacement level childbirth in most populations. And over the long, like I said, I've been doing this 40 years. If I'm here 40 years from now, I'm gonna be old. But there's some big changes out there. Some of it's been accelerated because of COVID. But you start to see some of these, the labor force and things like that. Those are some big demand side fundamentals to keep in mind, okay? And this is the kind of stuff we don't talk about every day, but it is impactful. It is impactful. Okay. We're missing a couple of the slides on that, but that's fine. Macroeconomic conditions. The Euro countries are already in recession. And we're looking at some of the problems that continue and will continue, and how long they'll continue is anybody's guess. So the chart on the upper right shows how the downturn has occurred. We're in recession. That's in the Euro area. And so what does that mean for cotton consumption? On the lower right, on the lower chart here, is the retail inventories. How do we get here where the retail inventories are just so high? Okay, so long story short, COVID hits, stores close down, cotton doesn't get shipped, prices collapse, we all will live through it. Supply chain, sitting there, nothing to do, global money center banks pump money into the economy, massive demand causes just incredible supply chain problems. Everybody wants to buy, everybody wants to ship, you can't get there from here. In an effort to keep their store shelves stacked, many firms bought 2 or 3 times what they wanted, what they needed, just to try and get it in. Okay, we get past that. Just as the stuff starts to show up on their shelves, recession fears. So now they're stuck holding all this inventory. Much of the apparel inventory is held in containers instead of in warehouses because they don't want to lose control of the containers. And there's certain brands out there that have enough finished product to not have to buy anything for another 2 quarters. So when you take that back a time, take it back, we don't see strong demand returning till the 1st or 2nd quarter of next year. And it may be next summer's season, fashion season, before we see really strong demand come back, provided we don't have a continued drop. Oh, there we go. A continued decline in the global economic situation. Okay, and this is also, there we go, on the lower left is the Shanghai to Los Angeles container freight charges. You got to ask yourself, how could the prices drop like that if there was demand? I don't want it. Okay, so we just went through all these different supply, demand, technical, structural, money flow, and we all think we got it figured out. Well, here's why you don't. Okay, black swans. There are more black swans out there right now than you can shake a stick at, all right? And this is fear's what's left when energy is wasted, uselessly converting the unknown into an emotion. And that is manifest to this chart. This is a chart of the US dollar compared to a number of other currencies. How could only the dollar be outperforming like that? And it's fear. Again, if it's the cleanest dirty shirt in the laundry, people want to be where it's going to be the safest. We know that our Fed is committed to bringing inflation under control and handling unemployment. Well, they're not going to back away until they have sure look-back figures that allow them to stop raising rates. Once they do that, we could see a hard reversal of the dollar, which would be beneficial for cotton prices. But when? You tell me. Some of the other things. Could we get another COVID wintertime or influenza shutdowns? Transportation supply issues. Diesel prices are already short on the East Coast. Russia, Ukraine. Nuclear or not? North Korea, South Korea. Nuclear or not? China, Taiwan. Now or later. Okay? U.S. midterm elections. We're sitting here today. We don't know who won. It was not a red wave. Someone said it was a red mist. There's changes coming in the political conditions in the U.S., good, bad, or ugly. We don't know. So higher energy, fertilizer, input costs are likely headed for a global food shortage, global inflation, global recession, and Mother Nature's meteorologic uncertainty. Those of you that are headed to the sourcing summit know that Thursday, day after tomorrow, or Thursday, Friday, they're expecting a hurricane to come through there, so don't get there early. All right? So all this uncertainty that's built into this is building up the case for risk management. You guys have, over the years, I know you've heard this because I've told you this, right? You got to manage emotions, risk, and create a more profitable, stress-free environment. That's your job when you're using the futures market. Long-term success comes from short-term best practices. This is an old line I learned in broker school. The people who try to get rich fast typically get poor the same way. And all you got to do is step out to the casino and you'll see that. Getting rich slow is better. Another thing I try to explain to my customers is the only thing that is instant is coffee and tea. Everything else takes some time. But during the changing times, you need choices, not obligations, which is why I'm such a strong advocate of using options. They have a higher degree of sleepability factor than futures. And using options today, I would say it's not imperative. It's imperative if you want to stay in business. And we've got a number of folks here that can speak to options and derivatives. We got folks from Eric's. We have options guys out there. Eric Matson's in town. He's one of the top options guys. There's a number of people to turn to for guidance. But here's my 3 Lawson's laws of options. So this is something I've sculpted over the years, watching success, watching failure. And these work. They work. Okay, when you buy an option, sell an option. Sounds simple. We know that an option is made up of 3 things: real value, time value, and volatility value. If you're going to buy options, the only thing I can guarantee is you're going to lose time value. All right? So why not sell an option that's going to recoup that time? It then allows you to have a position that's more true as a protection for your position, okay? When you buy an option and it doubles in value, sell half. Get your money out of the market. You can take it and put it in another position and protect yourself, but why not use house money? You hit the slots. Take your dollar, put it in your pocket, play with the house money. The other idea is when you sell an option in cotton for triple digits, buy it back when it gets to a single digit. If you're going to take in $500 by selling an option for 100 points, what do you care if you have to spend $45 to eliminate that risk? How many times have we seen some incredible changes shifted? Next thing you know, your position, which looked good, now looks terrible. All right, it's just not worth it. So those are the 3, Lawson's laws of options that over the years I found to be very profitable. Okay, the other thing is plan your trade and trade your plan. Simply put, when there is no plan, there are no rules. And when there are no rules, chaos reigns, okay? I always said this, and I've said this to a number of guys back in June, to a group from Brazil. Through the translator, I was trying to keep it simple. A hedging or a risk management strategy can be as simple as you'll answer 3 questions. How much, how long, which way? It's that simple. Don't overcomplicate it. How much do you have to protect? Over what period of time? And the trickiest part is which way? Well, for instance, if you're a spinner, unfixed, market going up, that can hurt. Own call spreads. But once you fix it, you might be at a disadvantage to your competitors if the market drops. Buy put spreads. It's a matter of which way does the market move hurt you that you need to anticipate and take some protection. And I say this, and I'm talking about it in very wide, broad terms because nobody wants me to get up here and detail an option strategy. It's like putting this pen in my eyeball, but that's just something I think you should do. Get ready, know what to do, and know how to do it. Just knowing what to do and you don't know how to do it doesn't do any good. And then be ready and proactive, not reactive. Okay? Nobody's always right. Nobody. So that's where the option side, creating strategies, it allows for some fallibility. If you've miscalculated or the market throws a black swan at you, and you won't have a fatal flaw. You'll get bruised, but you'll get back. Recent market volatility proves the efficacy of using options as a risk management. So for 37 years, option volatility stayed, the implied volatility roughly was 18 to 27%. At 18, below 20%, you bought volatility if you were an options player. Over 25, you sold it, okay? We were 58 yesterday, 58%. And it tells you that in order for someone to sell an option to you, to give you the right but not the obligation, you got to pay them a lot of money. That's how much the uncertainty is out there. And it's why when you go to buy options, I suggest you also sell so that you're able to recoup some of that high volatility pricing. And or look at derivative products that allow you to have these products build into your portfolio for protection. And I think you're going to hear some more about that from Merrick a little bit in one of the other talks. And having this, what's going on right now, we have best practices that I can remember that worked fantastically, 2017, 18, 19, COVID doesn't work. Things got completely turned sideways. Now we're trying to deal in a post-COVID world. Okay, so what to do now? Come up with a strategy. Basically, strategies are typically built with fundamentals and money flows put together to give you an idea what the macroeconomic conditions are and what the fundamentals of cotton fit, how they fit under those macroeconomic conditions. So that's your overall strategy. And then pick up tactics. What structural issues, as they develop, will impact the market? Which technical points are you going to spur the specs and the hedge funds to work? Remember, you guys understand the physical market. You can understand by staying in touch with the right people, and I've got a list of them I can give you outside in the lobby, who follow this stuff on a daily basis and can tell you, this is what the hedge funds are looking for. They don't know what you know. Advantage you. You understand the fundamentals. You understand the supply, demand, what's out there. You can read the charts. You can understand the macroeconomic situations. They still don't know what you know. Advantage you. So keep that. This is a little addism I wrote up here. Complacency is where hope goes to be disappointed. Don't do nothing. Okay? Complacency will kill you. Be proactive. The longest known measurable period of time is between now and eventually. So act. And the only thing that travels faster than money The only thing transactional light is money, so act now, okay? You're gonna see this over and over and over again. Stay engaged and informed on all the non-cotton influencing issues. I always tell my hedge fund guys when they ask what you guys are thinking, and please don't be offended. Trying to get the guy off the phone, I'll say, yeah, you know, they got their heads shoved up the bale. They're not looking at you guys. Click. Stay engaged. Stay informed of the things that are going to affect your world that aren't in your world, because that's going to be where you'll stay ahead of the game. Black swan threats, they're begging the use for options versus futures and options versus doing nothing. That are derivative products in order to give you some protection without obligation, all right? In addition, there's a tremendous shift post-COVID in credit terms. Logistics credit terms, how to have credit filters. People will come in and against lines of credit that you may not want to extend. They can insert themselves profitably for you and give you additional flexibility in your businesses. And all of this builds because in COVID, we saw a segmentation of the supply chain where some companies just could not take the credit risk. Other companies inserted themselves, and we can introduce you to those people that can handle that. Look for business-to-business relationships that have versatility and innovation. One-trick ponies don't work anymore. You know, there's a, you know, I'm told I'm a commodity broker, and there's like 4 of us left in the world. You know, what we do now more is consult, advise, and keep people from getting hit from behind. Yes, we still trade futures. Yes, we still can get your business done and introduce you to the right people. But if you're with a one shot, one deal, one type of relationship business with someone, you may be missing opportunities, okay? And if you forget, if you remember nothing in this whole presentation, okay, remember this last point. Seek to do business with partners that have a mutual beneficial business relationship in mind, not just peddlers of products, not someone who's just gonna try and make money on you and go away. Because over the long run, it's the relationships that count. And as I started out when I first stood up here, coming back together after 3 years, you know, you forget how much you miss this interaction. And I think as we go forward, it's the relationships that you build in meetings such as this, that we get back together again, we start to build those relationships again where we become partners, not just peddlers, and that's where I see the future going for our business. So with that, I'm here to answer questions. And I think it's been explained how you guys answer questions to show up on the screen. Okay, the chart was stuck on the screen. What does it tell you today? When we look at this front month contract, December, I think it's got 90 cents in it. I think we have to still get above a 90-cent level in order to scrape out the remaining hedge funds that are short. And at some point, I think once the December goes off the board, we get past the options expiration, we get past the delivery. I'd expect the March contract, if nothing else changes, we'll probably try and test the lows, the recent lows. Now for new crop, I think that the December 23 contract has put in its lows. When we look ahead to the potential production, you know, the old adage I was told that red deck 23, the next deck, its job is to get seed in the ground. If it worked for you, you'd fire it. No one's, at these prices, we have a weekly call with some banking entities in West Texas who lend money, and what they're telling us is they're not even gonna lend you money to grow cotton at these levels. So it's not that the farmer has a choice, he doesn't have the money. If you can't get the financing to buy the production, you're not gonna plant cotton. So I think that longer term, there's gonna be less of a desire to sell the back end than there will be the front, and that's where I see, I think red deck has already bottomed. Okay, how far instruments, EW Fibonacci, can read the macroeconomic factors and show in charts? I think you say how far forward, or You know, the Elliott Wave Fibonacci, I'm not trying to be offensive to anybody. It's like a religion, you know? You believe in it when it works on Sunday mornings, that's great, okay? But there's so many times that they readjust their interpretation, or they do look back and say, well, this is why this happened, so now that should happen. Yeah, I don't know. So the Elliott Wave and Fibonacci, they're good explainers looking back, and can tell you maybe the extent of some trends. Personally, I've never been a fan. Maybe it's just too complicated, perhaps. Okay, as a hedge fund, how would you take spread positions without a fundamental understanding? If I was a hedge fund, I would look to own December, sell March as the December caps out. Simply on a value that, okay, something you got to understand about one of the structural pieces of the market is you're a money manager. You're going to manage money, and you're going to put cotton into your program, and you got to tell people how you're going to trade it through your prospectus. And you have to lay out the rules. I'm going to buy this, I'm going to be in this market, and they will typically they will be in the contract month that has the greatest liquidity as defined by open interest. So they're going to look at the front end almost exclusively. So when they get in or get out, it's going to have a massive effect on the front market, the front month, than it will on any other contract. So for these hedge funds, I think that they're going to look to move onto the March contract on the short side, and if they can, on a spread basis, buy the new crop. At least that's what I would suggest they do. View for Chinese cotton production. Okay, what is the view for Chinese cotton production over the long run? Okay, I've long held this. Two theories, one comical, one very serious. Okay. In China, you have to eat breakfast every morning before you get dressed to go to work. Food is more important than fiber. And that's true everywhere, okay? If you read history, any country that's going to starve to death is going to go to war. You're going to die anyway. And it may happen in North Korea first, but one of the reasons I believe that our country continues to try to be accommodative to China is to keep them fed. We don't need a bunch of starving people wanting to go to war with us. So I think there's going to be a push to food versus fiber. If you go back into the 1950s and 1960s, the government that's in place today in China came into power during the starvation back then. And the last thing they want to do is have people starve. So I think you're going to see them continue to import food, and I can't help but think, even though it's an autonomous region that the Army controls, that Xinjiang, because of both the pushback in the global fiber world and the need to feed the country, is probably going to shift away more towards food than fiber. That's just my estimation. How far? Okay. Most of the Elliott Wave is wrong, but pretty much every analyst read Elliott Wave for what reason in particular. Remember, as I said, the charts are just a reflection of what people are willing to buy and sell for. So if you see a theory that can go back and explain a lot of chart moves, you want to say, okay, maybe that'll come into play going forward. So they have to, I don't say have to, but they're compelled to follow it simply because it's just one more indication where they may want to put a sell stop in or a buy stop. And at some point, it becomes a self-fulfilling prophecy. If enough people believe that a death cross where the 200-day moving average crosses over the 50-day moving average, enough people believe that, then you're going to have it affect the market. It has nothing to do with cotton. It has nothing to do with your business. It's just what the money flow is willing to do and how they're willing to engage in our markets. All right, seeing backwardation in every contract, advice to spinners who need to hold stocks. Again, how much, how long, which way? If you've got stocks on hand, until you spin it and sell it, you have the risk of the market going down. Own put spreads on your inventory. Plain and simple. Own put spreads on your inventory. If the market collapses, you're at least going to get some money back. It's going to be it can be very inexpensive to have a put spread on to protect against that inventory. And if demand picks up, it's because prices are going up, your inventory is going to be worth more over time, and you're going to be out. You'll be in good shape. That would be my strong suggestion for that. Do you think merchants are able to create surge stock and volume to defend? Yes. Push of a button. If you look at some of the results we've had, well, even in the USDA numbers today, they increased the U.S. crop, and the reports we're getting from the classing offices, it's 89%, I think is the number, 89% tenderable. There's a lot of cotton that's going to be available for the board, and there's so much inventory in the mills today, they don't necessarily need the cash cotton now. So why not let the board carry it? So I could see, now don't want to name names, Joe, but you could see a push of a button and a tremendous amount of cotton end up in surge stock, because let the board carry it. Why not? Why not? Is the worst over? Are we going to see more demand destruction in the near future? My opinion is the demand destruction is already here. It's already been destroyed. I'm trying not to be that ugly American, so let's look at Europe, okay? I'm an average person in Great Britain. My food inflation has gone up 30%. I used to spend $1,300 on my forward pricing diesel, heating oil, on a scheme where I'd pay $1,300 a month. I could lock that in for the winter. $3,900. So if your food prices have gone up 30%, your heating prices have tripled, you still got to get to work, right? Energy. Provided there's not a bunch of layoffs, who can buy another shirt? Can't you put that off? Can't you wait? Because the amount of expendable income has been hit twice. Once, the ultra low interest rates and the free money is gone. You look at the credit card debt, it's exploded. People have spent all the free money and are now going on credit cards. So your income got hit. You don't get the free money. Low interest rates are gone. Oh, on top of that, double-digit inflation. So just to exist, just to live, they always called it the core inflation without food and energy. Come on. What does it matter what the economy is if you can't eat and you don't have energy? It doesn't matter, right? So you have to take that into account. So I think that once we get past the winter and the demands that are put on the consumers just to heat their homes, we should see some new revived interest. And hopefully, this recession that we're going to go through, that we're in some places, one short fat guy's opinion from over the West Coast, compared to the 1970s, this recent inflation is not organic. It didn't come from some natural shortage of supply. It was created by the money center banks pumping massive trillions of dollars into the economies to try and keep the world from collapsing. It was an artificial, if you will, surplant of money. Now, its cause is still there, but it may not last as long. If the artificial pump of money ends, you remove that inflation. The problem we have is most of the money here in the U.S. that the Congress has gone ahead and designated hasn't been spent yet. They say, okay, we're going to have this pile of money, we're going to give it away. They haven't done it yet. So there's still a tremendous amount of money that's going to go into programs, but not into the consumer's hands. So I would expect to see demand show back up first, second quarter of next year. If Chinese eases COVID restrictions, will it help the short-term demand? Yes and no. I think if they ease the restrictions, you're going to see demand for energy explode. Absolutely explode. The Chinese moved last week and bought fiber. A lot. Close to 1 million bales. Okay. How much more do they need? I think it will improve a lot of things. I just don't know if it'll come back to us. The Chinese may wait to buy cotton after the December goes off the board, and they may be in the market. Again, we stare at the screen all day long. I can tell you when an EFS hits, if, you know, who the likely players were. And, you know, sometimes we handle that trade. I can't tell you then, but I can tell you, you know, you might see one coming. So those are the kind of things. So at the end of it all, I would ask you all to reach out to the people that are professionals in this industry. There's four names out there that I hold to be former heads of big merchant companies that are available for consultation, for advice. You know, you don't got to hire these guys for $500,000 a year. You can pay them to consult and keep you informed, keep you involved, keep you abreast of all these other factors that are now affecting our markets more so than ever before. So I think that's it for me.
Ron, thank you very much for giving us your time, your insights. I think that the breadth of questions just is indicative of how engaged the audience has been today. Thank you very much indeed for joining us and taking the trouble. And I know you'll share your expertise with the future questions that will follow you into the foyer. I could ask, please, everybody to be back in the room for 11:30. Time to grab a coffee or a tea, and then be seated again for 11:30 for the next serial. Thank you.